How's it going, everyone? Welcome to another episode of the Dividend Digest. This is going to be a quick, raw, and dirty review of UPS. It hit a 52-week low, so we're going to try to figure out if it's undervalued or if it's a value trap. And by the way, I had an allergy reaction earlier today, and I took a Benadryl, and I'm not going to lie to you. 20 minutes afterwards, I crashed pretty hard. I woke up, and then I was like, you know what? It's time to film. So if I feel low on energy, that's why I'm waking up. Anyways, when we look at the stock, the overview, right? The PE ratio is less than 20, which is pretty good. I mean, the rest of the market, the S&P 500 is trading for about around this range right here. The dividend yield is 4.8%. It's pretty juicy, I think. And as you can see, $133 was the 52-week low, meaning in the past 1 year, that's the lowest price it hit. And as of right now, it's sitting at 135. So pretty low, and it's got my attention. So I'm trying to figure out if it's a good or a bad time to be piling into UPS. And if you zoom out 5 years, the last time that it was around this price was almost 5 years ago. Almost 5 years ago. But it is on a downward trend. And when we look at UPS, it's kind of surprising as to why they're being smashed so low to the ground right now. About a month and a half ago, they released their Q1 2024 earnings, and it wasn't a pretty picture, right? Investors in Wall Street were not happy. They reported revenues of $21.7 billion, whereas last year it was $22.9 billion, meaning they went down. And not only that, their operating margin went down, meaning their profits are not as good, and their earnings per share $1.30, whereas last year $2.20. Not very good, right? And they also have some other headwinds that they're dealing with. Number one is they reached an agreement with their union for a majority of their workers. They're part of the union. And then there's like 20 to 30% that are seasonal workers that are let go after each peak season. And peak season is usually from like end of October all the way to January, when people are doing e-commerce shopping, Black Friday shopping, Christmas shopping, you name it, they need extra hands on deck to help out with the overload of packages. But anyways, for the people that are a part of the union, they reached an agreement to increase their compensation by a lot. Meaning, if you have tenureship with the company, you're going to make six figures. It's just a matter of fact. It doesn't even matter where you live, the location. If you've been with UPS for over 10 years, you're probably going to reach six figures once you take into consideration overtime pay and your salary incentives and the bonuses. So UPS is a pretty good place to work for, from my understanding. Of course, it's physically intensive, but if you don't mind sweating and working 50 to 60 hours a week, it's a good place to make six figures. And another headwind that they have is that Amazon, for the past, 10 to 15 years, they have been increasing and building out their own supply chain infrastructure, right? They took that playbook from Walmart, which Walmart did back in the 1980s and 1990s, and investors hated Walmart for that, right? They're like, why are you spending so much money buying up trucks, warehouses, and building out the supply chain network? And then you could see the dividends that it paid for Walmart later in the future, whereas like Kohl's and some of those other retail stores had to shut down, whereas Walmart thrived. So Amazon decided to not only build out their warehouses to become a monster in the e-commerce business, but now they also have the logistics part figured out, right? They have, if you order something from Amazon, like maybe 9 out of 10 times, someone from Amazon is going to be delivering it to you. And it's usually a contractor, right? Like they'll wear the Amazon vest, but they're not actually like an Amazon employee. And a lot of people sign up for that because of the flexibility and, you dictate your own hours. But with all that said, Amazon was one of UPS's biggest customers, right? I think at one point, 11 to 12% of their revenue was from Amazon. However, what's happening right now is Amazon is slowly weaning off of using UPS's services and instead delivering everything by themselves. And I think, from my understanding, because this was the last job that I had when I used to work in corporate, was for e-commerce, especially for the last mile delivery. It's a lot of tangibles and variables that you need to take into consideration because you want to be profitable, right? And for the most part, the last mile is usually when the profits are lost. And so a lot of different companies are rolling out different methodologies of getting that package to you. Like, it doesn't cost as much when you just fill a train or a truck full of packages to go from like Albuquerque all the way to Phoenix, right? But once it gets to Phoenix and it needs to go into the more suburban or rural areas, that's where the profit is kind of lost, right? Because you're not going to have the density of packages going to a certain neighborhood. Sometimes you're going to have like 6 packages going to that neighborhood, whereas you need 20 packages in order to be profitable. And because of that, a lot of the companies were just outsourcing that last mile delivery portion to the post office, right? But now what's happening, and the post office and UPS, but what's happening is Amazon is now building out their last mile delivery infrastructure, and they're using UPS even less, because in the past they were using UPS for the major interstate shipping from like California to New York City. And then eventually they just use them for last mile delivery. And now they're getting to a point where Amazon is using UPS less and less. And case in point, when I was pursuing my MBA, one of the career paths that a lot of people did not want to go down, but they had to anyways because it offered a visa, especially if you're an international student, was the Amazon Pathways Leadership Development Program. If you know anything about the MBA hiring pipeline, you know there's 2 major career paths that people want to go on, right? One is banking, investment banking, because you can make like 200, 300 grand all in your first year as your compensation. Number 2 is consulting, especially with one of the big firms like McKinsey, Bain, or Boston Consulting Group. You go down that path, you can clear 200 grand easily. Another one is, being a product manager, but that's not as popular. So one of the options that had like a 100% job offer rate that nobody really wanted to do, but they're hiring because they're expanding so fast, was Amazon's Pathway Leadership Development Program. And essentially what happens in an LDP is you are accelerated in your promotions, right? So you start at the bottom of the ladder and you become a general manager at the end of like 4 to 5 years, and your total compensation is like easily $270,000 to $300,000. But anyways, Amazon would hire like hundreds, maybe like 250 to like 400 MBAs every year to throw into their logistics, e-commerce, and warehouses all over the country because they need people, I guess, with the financial background to lead these brand new built warehouses. Just to give you kind of like a real world example of how fast Amazon is expanding. And not only that, the last headwind that I want to talk about is the UPS is kind of I guess, another way to track the health of the economy and how the people are doing. It's an indicator of the overall economy, because if people are doing great and businesses are thriving and people have more cash on hand, they're going to be shopping more often. And if people are shopping more often, that means e-commerce sales are naturally going to go up. And from the recent data, it shows us that people's consumer behaviors are slowing down, meaning the economy is slowly cooling off, meaning indirectly less e-commerce packages are going to be ordered. And by the way, their 2024 full year guidance, they're predicting revenues in the ballpark of about $92 billion and optimistically up to $94 billion. If you look at their revenue throughout the years, right? In 2022, they posted $100 billion. And prior to that, they were posting great growth, right? But as of last year, it went down by negative 9%. They posted $90.9 billion. And this year, they're saying we might hit $92 billion, maybe $93 billion. So their growth is tremendously decreased. which is why their stock price, in my opinion, is taking a huge hit right now. However, with that said, it's not all doom and gloom when it comes to UPS, right? I think there's some tailwinds coming their way. And tailwind is when you think about a ship and the wind is blowing behind your back, that means the ship is able to accelerate faster, right? Go faster. And it's a growth driver. So here are some of the things that I can think of that are going for UPS. I think as of right now, especially among Gen Z, there is a growing movement of people that are actively avoiding Amazon, right? Because they're understanding how big of a conglomerate that Amazon is turning into. And so there's people, a growing number of people that would rather buy directly from the manufacturer. So say you're looking at a pair of shoes that are Nike, right? Usually, if you're a baby boomer or Gen X or somebody older like me, a millennial, you would just buy it on Amazon, right? You want the best price and whatever is comes with the least amount of hassle. But when it comes to like Gen Z, and I guess people from other categories that are against Amazon, they would rather just get it from Nike directly off of Nike.com. And so what that means is Amazon is not going to be able to procure or ship that product, right? Who's going to ship it? Of course, it's going to be UPS. And as this statement right here states, FedEx and UPS are the biggest domestic, I guess, in the US shipping companies, right? And Amazon is trying to encroach upon their territory, but that's contingent upon people buying that product from Amazon. So, in my personal opinion, as Amazon pisses off more people and people boycott Amazon and they buy directly from the manufacturer, especially like for me in the past, like what, 2 to 3 years, I've avoided buying from Amazon. I just buy directly from the manufacturer. And that's because I've noticed that you can get better deals. And now most companies offer free shipping, right? So I can't really think of any reason why I would just buy from Amazon when I can just buy directly from the manufacturer and get a better price, better service, better warranty, better everything, right? So I think that's a growth driver number one. It's very subjective, but it is a movement that's growing. If you're skeptical, just Google it. Just say people avoiding Amazon, and you'll see a ton of news articles and social media posts about it. And number two is this: FedEx and the post office just announced that they are not going to be renewing their contract. So, what happened is for the past handful of years, FedEx has been responsible for doing all air shipping for the USPS, the post office, right? Our government. And as a result, they were getting a steady cash flow from the government to compensate them for this. And in lieu, UPS is the one that just negotiated a contract with the post office. So now UPS is the one that is going to be able to ship all of these packages for the government and get that steady cash flow. When we take into consideration what happened in their last earnings report about how, like, hey, the package volume has decreased and the revenue has declined, and our guidance is looking pretty bearish. We're predicting a 1% growth rate from the year prior. Yes, I said 1%. When I think about this new contract that's going to be rolling out sometime this fall and a steady cash flow coming from the government, I think that's going to be a good look for UPS. Right. So I think it's like a balance thing. As they're losing more and more packages for Amazon, they just gained millions of packages for the post office. So I think that's a really good thing. And with that said, I think at this point, I want to go ahead and run some intrinsic valuations to figure out an acceptable buy price for UPS and to figure out if it's actually undervalued. And my apologies up front. Usually I'm a lot more polished and my videos are a little bit more organized. However, this is a dividend digest, meaning this is a quick, raw, and dirty version of the videos that I usually do. For time's sakes, I'm able to just freestyle, record, and upload. Saves me a ton of time because I ran a cost benefit analysis and ROI, and I make 60 cents on the hour for when I make my usual videos. However, when I make one of these videos, it allows me to spend a lot less time. So forgive me. If you want a more in-depth analysis where I go over the intangibles on a deeper level and some other metrics and whatnot, let me know. I can do it again and make it a lot more detail oriented. But anyways, this is the multiples valuation. And from the multiples valuation, the stock price for UPS, basically the multiples valuation looks at the industry peers to figure out a market derived price, right? And for UPS, that's going to be $149 a share. We'll just say 150. And right now they're currently trading for about 135. So they're about in line with expectations. When we look at their competitor, FedEx, their PE ratio is 14.1. And I believe UPS right now is just shy of 20, which means UPS is trading at a premium. And that's because their stock price is getting crushed. The next one is going to be the DCF. The DCF is essentially the free cash flow telling us an intrinsic value for UPS. And when we look at their free cash flow, it is all over the place, honestly. Even prior to the pandemic, their free cash flow went from $6.4 billion down to $2.3 billion, which is a decrease of 64%. Atrocious. However, during the pandemic, people could not go shopping in person because of all the different regulations and rules in place depending on where you lived. So online shopping just exploded in 2020 and 2021. And that's why you see their free cash flow growing at a rate of 3%, or sorry, 3 digits, 118%, 129%. Pretty awesome. But since then, it's been tapering off and it's not looking good. It's been going down by negative double digits. So taking that into consideration, the free cash flow, the average growth rate from year over year is 24%. That don't sound right to me because sometimes it's up by triple digits and sometimes it's down by double digits. So instead, we're going to plug in 8%. So basically, we're saying that the free cash flow from 2024 all the way onwards is going to grow at a rate of 8%. Taking that into consideration with some balance sheet numbers, and their debt is not looking good. And that's because they're probably taking on debt to service a lot of their vehicles and warehouses and the equipment thereof. And that's why that kind of makes sense to me. So taking an 8% free cash flow growth rate with some balance sheet numbers, that gives us a DCF price for UPS, $139.80, which would be $4 above their current trading price. Sounds pretty reasonable. Now, the DDM is an intrinsic valuation for UPS based on the dividend and the dividend growth rate. Now, their dividend is, I would say it's looking pretty juicy, but the growth rate is kind of wonky, right? During the pandemic, when they were making a lot of profit and business was thriving beyond belief, they increased their dividend by double digits, right? 49%. However, once they realized they were running into some financial issues with package volume decreasing, revenue decreasing, margins decreasing, and the compensation packages for their workers going up, their bottom line is not looking too good, right? So they decided to increase their dividend year over year from 2023 to this year only by 1 penny. So when you look at their average dividend growth rate, it's 6%. However, I don't think it's going to be able to grow at a rate of 6% year over year, especially because this year they're predicting a 1% growth rate, right? And then after that, I think on the earnings call, they said something like a 2 to 3% growth rate in 2025, and then they expect to return back to normal and high single digit or low double digit number like 9% or 12% eventually. But anyways, with that said, we're going to say 4%, meaning their dividend is going to grow at a rate of 4% year over year. That intrinsic valuation is going to be $169 for UPS. And the last one is going to be the Graham's valuation model. Essentially, their growth rate projection alongside with the corporate bonds yield rate as of right now is going to tell us how much UPS is worth. And that number is going to be $134.12. And remember, UPS is currently trading for about $135. So according to the Graham's valuation, it is overvalued by $1. After doing all of those calculations, now we're going to try to figure out what the intrinsic value for UPS is. And that's going to be $148.33. I'm so sorry, guys. My eyelids are so heavy right now. I'm so drowsy from that Benadryl. Um, okay, $148. Current trading price is 135. Let's see what the Wall Street analysts believe the price target should be. Wall Street says 165. And Morningstar says that the fair valuation for UPS is 158. And as of right now, 135, they give it a 4-star rating at its current trading price. They say that if you can buy UPS under $110, that's a 5-star price, meaning super good discount, good clearance. And if you buy it over $213 a share, then you're just overpaying for it. And by the way, I don't know if I mentioned it, but Morningstar says that UPS's economic moat is super wide, meaning they have an economic moat. And I agree. It's basically a duopoly, right? It's UPS or FedEx when it comes to the independent shipping companies in the US. Now that we looked at all of these numbers, I'm going to try to figure out an acceptable buy price because as UPS trades near their 52-week low, I'm going to be keeping a close eye on the company, especially the stock, because if it reaches a valuation that's just too good to pass up, I might buy a share or two. So with that said, let's go ahead and do this. At $135 with a 10% margin of safety baked in, then the acceptable buy price becomes $133 a share, which means it is overvalued by $1.50 if you're looking for that 10% margin of safety. But if I were to say something like, I don't know, 9%, then it's still overvalued by 2 pennies. 8%. Okay. With an 8% margin of safety, then you get a good deal on UPS if you were to buy it at its current trading price. You get a discount of $1.46 according to an 8% margin of safety. But anyways, if you're wondering what my opinion is, I think when it comes to UPS, as of right now, the bar is set very, very low, right? Yeah, Wall Street just thinks this company is crap. And the company confirms that viewpoint by saying, hey, we're only be able to grow 1% this year. Things are not looking good for us, right? So the expectations, super low. So what I think is if they are able to, pick up another contract to be the exclusive shipper for a wholesale producer or a manufacturer, or secure some contracts with some different S&P 500 companies to be the exclusive shipper for their products, and they can get their revenue and margins back in line, and they beat the expectations, I think the stock easily will blow back up. Easily, right? Because when we look at their peer FedEx, they're doing pretty good, right? And that's because they didn't paint a dark and gloomy picture like UPS did. I think UPS and their leadership team is a little bit more realistic and cynical about the future rather than, talking out of their butt and being optimistic. So it really depends. As for me, I'm going to be keeping a close eye on this company because it seems like right now a lot of companies are super overvalued in this stock market. So when I'm able to see a good, high quality company, especially a dividend compounder with cheese on discount, yeah, that catches my attention, right? So I am going to be monitoring this company. And I think as it hits around that $130, $125 mark, I might jump in. That's just my personal opinion. If you think this company is looking cute or delicious, do your own research. Please try to figure out if you think this is a good company. And if not, please let me know. Please let me know why UPS is a dumpster fire. I think it's half decent. I think their story, especially in the next 2 to 4 years, will be okay. This year and the next year, yeah, things look a little gloomy. Anyways, this has been another Dividend Digest episode. It's just really dirty. I get it. I'm not all polished, and I apologize. I'm really sleepy. Had a long day at work, took an allergy medicine, and I'm drowsy. Forgive me.